Okay. Let's go on now. We are last on statement of changes in equity. Statement of changes in equity, of course, is nothing much here, right?
Okay.
You should do remember we already showed the equity. This is the equity, right?
Yes, sir.
See, yeah, this is our equity. So we just need to know how. We just need to move how it goes at the beginning and to how it arrived, because this one will be the figures at the end of the year. So we just need to know what happened from the beginning to the end if you have those figures. So, I usually consider it very simple. That's why you can see ABC group statement of changes in equity. We also say for the year ended, because we need to know what happened during the year, right?
Okay.
The total figure, you can see, we open with the opening balance here. You would have your opening balances and the total figure.
That's the balance for the last year.
Yes.
For the last year.
Exactly.
Okay.
And then at the end here, you would see that you have the closing what? Balance. This closing balance
Okay.
is what is read on the statement of
That's
financial.
opening balance.
This is not the opening now. This is the closing you're saying. Closing balance for
Yes,
the.
I mean next year.
Okay, yes. Closing opening balance for the next year. So it means that
Yes.
we come and take this figure, right? Should be like these ones in the statement of financial position, because these are the balances at the end of the what? Of the year.
Of the year. Okay.
So what we just need to know is how it all changed from the beginning to the end. So like maybe you could have, and now you can see something here, incorporated a very nice matters. Look here, after having the opening balance, look, prior period errors or change in accounting what? I told you, if you have these changes, we usually incorporate them to adjust the opening what? The opening balance. See how I included that? I told you, as per IAS 8, prior period errors and the accounting change in accounting estimates are applied for retrospectively. So if there was any change, you account for that, and then you adjust and get the restated what? Balance. This is the restated opening balance, right?
Yes.
Exactly. After that, now whatever happened, it's simple. Because you'll have done everything to get the figures in the statement of financial position, so you'll be knowing what happened, right? For example, maybe you know that the opening balance and the closing balance were the same way of share capital, so you could say it could be maybe there was no difference, but you have to prove for yourself. But there are some matters which you should obviously check. For example, maybe payment of dividend. If you pay ordinary dividend, if you pay dividend is paid out of retained earnings. Ordinary dividend from ordinary shareholders is paid out of what? Retained earnings. So you have earnings and they reduce it, right?
Yes.
Maybe there is something which you should obviously check. Total comprehensive what? Income. Because like I told you, total comprehensive income should always go to equity each year, right? So on comprehensive income, you would have profit for the year, but also other matters in the other comprehensive what? Other comprehensive income, right?
Income.
Yes. So what you do here is this, right? If maybe you had the profit for the year should come on a retained what? Earnings. If it's a profit, the loss, it would be negative. Maybe you had a revaluation gain. You can see it is here in the revaluation what? Surplus. Can you see it here?
I almost wanted to ask it. Say, okay, other comprehensive income. We are not taking it to the revaluation gains or surplus.
You are taking. Don't you see it here? Don't you see here? Look.
Yes.
This. Okay. You wanted to ask that total comprehensive income.
I wanted to ask when you said you take it to retained earnings.
Okay. No. This is total comprehensive income. I've told you that. Total comprehensive income comprises of profit for the year and the other comprehensive income. Two things. Profit for the year is what comes to retain the earnings. And other comprehensive income, you look at the actual component to know where it should actually go, right?
Okay.
For example, if it was a revaluation gain, it would come to revaluation what? Surplus. Right. Yes. So you just look as it is and everything will be fine. The other matters which will be common will be like issue of shares. You know, we have the share capital. So if you do issue shares, obviously share capital would be affected. Am I right?
Yes, sir.
So share capital will obviously go up. You can see share capital here. But like I told you, share capital is based on the nominal values that are described in the memorandums and the articles of what? Of the association. Have you ever heard of the term MEMAT, Memorandum and Article of Association? When the company is formed, there should always be a memorandum and article of association for, you know, they kind of act like the constitution, that can
Yes,
be
like
used to be what?
registering it.
Yes, the register of companies is involved, right? And it is the register
Yes.
of company that says, okay, you and the company, each of your share would be worth $1, for example, right?
Yes.
So if the register of companies said that the company would be the share of the company would be worth $1, when the company has performed well and it has been the shares have been sold, let's say for $4, we don't care. We would still take $1 to share capital. The excess, which is 3, should go to share what? Share premium.
Premium.
Yes, we get that. And
Okay.
then we go to the other factors. So these are just possibilities.
Sorry, there's this general reserve.
Don't worry about. That's why I just said general. You know, the term itself is general. So you can what do you want me to do in general?
I've seen I've seen the two X's that directly to the line
No,
of
no,
total
no.
comprehensive
It's
income.
just there. If it's general, maybe the question would directly tell you, okay, take this to general reserve, right? Or maybe if you have an item,
Okay.
you have
After
an item.
dividing the dividends.
Or maybe you just have something that doesn't know how to be taken. You can say, okay, just take this to general, right?
Okay.
For matters that are obviously clear, you should take them as appropriate. And let's move to, we have here, we say transfer of excess depreciation. Transfer of excess? If you do remember, when we are doing revaluation, I told you that if you revalue an asset upwards, its value would go up. If its value goes up, it means depreciation would increase, right? Let's say previously we had a depreciation of 10, but after revaluation, depreciation is now 12. You see this?
Yes.
It's now 12. So we have an excess of 2. That excess of 2 now, we say that since depreciation has increased, it has led to the decrease of profit, right? The decrease of profit means a low profit. A low profit means a low retained earnings because profit for the year is taken to retain what? To retain the earnings. So retained earnings would be low. So you can see while retained earnings would be affected and they would be low, this comes at the expense. This expense arises from the fact that there was a gain in the revaluation surplus had gone up, right?
Yes.
Retained earnings says, okay, my friend, it's fine. I agreed that there should be a revaluation gain, but that caused depreciation to go up. The result of depreciation going up led to a low profit. A low profit led to my retained earnings going down. So you need to compensate me. And the revaluation surplus says that, okay, my friend, we are the top. We are the strength of financial position. And so it's right. I would compensate everything to you, right? So we this you see this difference of depreciation, which is 2. We say okay, no problem. So revaluation surplus agrees.
Hello. Hello.
Hello.
Now you are back.
Okay, so I told you that this is what happens, right? Retained earnings went the reversion surplus because the reversion surplus went up. So this difference of 2 reversion surplus tells the retained earnings that, oh my friend, don't worry. I know that revaluation going up actually messed up with your figure, right? So no worries. I'll be compensating for you, but each year, don't force me to do everything. Maybe I had a huge revaluation upwards, right? Revaluation gain, but I can take it all to you. I'll be giving you little by what? By little each year. So the first year, I'll plus reduces by 2 and takes it to return what? Earnings as a compensation. The next year, the same. Then next year, the same. But now this method of taking the difference between depreciations, it has said the transfer of excess depreciation. You usually don't like to use this one, right? I told you,
Yes.
16 PPE, we usually take the gain. You take the gain, you divide by the remaining useful what? The remaining useful life. You take the revaluation gain and you divide by the remaining useful life. Because, there are issues. Presume initially you had the 10-year depreciation, but maybe before getting this depreciation of 12, there was a change of useful life. So you could see that one depreciation has been determined using a different useful life to this one, right? And that one could cause problems, yes. But no worries about that. I think you shouldn't worry about that. That's none of our concern here. What we just need to know is that when you have the excess of depreciation, you reduce it from revolution surplus and you take it to retained what? Earnings. You can see revolution surplus reduction. Retained earnings, we increase. This is the point, right?
Okay. Yes, sir.
That's what you should focus on. And then we have what? We have other transfers between reserves. Maybe these are just other transfers. These are no, maybe they would tell you them by themselves, okay?
Okay.
If they could just tell you by themselves, okay, maybe we have a lot of retained earnings. Then someone tells you, okay, I have a lot of retained earnings. Let me, you can reduce the retained earnings and take them as share what? As share capital. But this one should be stated in an exam. You can just decide by yourself, right?
Okay.
You have a lot of issues like this bonus issue. Have you ever heard of something called rights issue and bonus issue? Have you ever heard of some of those things?
Yes, I'm familiar.
You are
They
familiar?
are so familiar too. Yes.
Okay, so
Bonus
you can
and
see
right.
the rights issue is normally you can just shares are advertised, right? Usually to existing shareholders with respect to their respective shareholdings. It means the one with more shares has the chance to purchase more. Of course, we usually call those preemption rights. That shares are first advertised to the existing shareholders. If they fail, then the others can be invited. And usually, shares will be sold below market price. You know why? On rights issue, this is because when dealing with rights issue, we won't have issue cost because the company can just advertise to its people direct without going to the market, right? If you go to the market and you advertise at the full market price, you would still have the cost of issue and what. So it isn't like effectively you would gain the total price that you asked for, right?
Okay.
Yes, because you pay something first and then you gain something. So net price, you would have gained less. And so we could also have a bonus issue. This bonus issue, contrary to the rights issue, rights issue, you actually get the funds, yeah? You tell the people, okay, bring this fund. Maybe the share is $3 worth, but no problem. I'm selling it at 2.5. So people come, they bring the money, you take it. But bonus issue, no money is given, right? Bonus issue, the company may just say, oh, you know what? Maybe you could just say maybe our share premium is too much. We have a lot of share premium. Share premium would always remain that way if you don't use it, right? Because as you have seen how it is generated, it comes from being paid above the nominal value, which goes to their share capital. So whatever you're paid beyond nominal value of share capital, it goes to share premium. So if you leave it as it is, it would remain there forever. That's why some ways they are usually found to reduce it from share premium to share what? To share capital. So by bonus issue, we just say, okay, my friends, maybe let's reward ourselves, let's provide ourselves with more shares. So maybe we say we are going to reduce 1 million from share premium, we convert it to shares, and then we spread these shares and they become share what? Share capital. You see that? Yes. So even
each and everyone who add on to their share that they have.
yes. So you could
Okay.
see that bonus issue could also show everything. Okay, maybe we are changing this and you are taking it somewhere. It could be there, right? Like you can see an
Okay.
example here. You can see this one, I think. You can see this one, for example, maybe you have taken it from retained earnings, for example, right? Take this from retained earnings and take it to what? To share capital. I'll just take it as an example. But you would have
Okay.
to follow what you are told in the exam, right? Okay,
Yes, sir.
lastly, we are told here for group financial statements, non-controlling interests would appear. Don't worry about this in these columns. When you are preparing the consolidated financial statements, but here we are not doing that, right? You know,
Okay.
on consolidated financial statements, let's say the parent owns 80%, you could have, okay, can you afford me like some seconds? You know, we are finishing, eh?
Okay.
You have to revise this a lot, and then after revising this, you'll go through it. We'll come and do the example tomorrow. One full example. It will be
Okay.
one, but I'm just going to show you how that example will be, right?
Okay, sir.
Yes. So wait. Okay, so you can see this. Let's say it's a consolidated financial statement. Maybe you're owning 80% and 20% is owned by other people. So we usually prepare this one would be for your 80%. But if you need to show also the 20% that you do not own, we usually write here NCI, non-controlling what? Interest, and they would just put it here. But of course, you're not going,
Okay.
we are not even dealing with this actually. You don't have to deal with it now, right? It shouldn't confuse you. You let
Okay.
it be, yes. So
Okay.
tomorrow, not tomorrow, you have to do two questions, not one.
Okay.
There is one question. The first one we'll skip. We'll skip the first one. We'll deal with the second. You see, I chose this one because it has a lot of things to deal with. For example, you see these
Okay.
notes. And for these notes, of
Yes,
course,
sir.
I made an error. I started with this word X instead. Of course, this one was Roman 1, but no problem. So we have the first one, it is
Okay.
speaks of provision. You would speak on I-37. You go and revise. We have land and the building.
Okay.
On I-16, we deal with is what? 16. You go and deal with it, right? The third one,
Yes.
are plant and equipment, I-16 again, you also see this. We have investment properties here,
Investment
I-40, you will
property.
deal with this, right? You see,
Yes.
equity investments, you're going to deal with this too. So actually, you're going to see a lot of things here, right? But
Okay.
also here,
Okay, sir.
let's go down this one. Going down, going down, going down, going down here. We have corporation tax. We'll see about S12. No worries. S12 we haven't done, but I'm trying to look a way for you to get the simple concept of S12 to be able to meet the exam. Because I'm trying to look, most students dislike this topic. I don't know why, but they do dislike it a lot. But so what you
Okay.
really need in this topic is to get the concept. Just get the grasp the logic. Or this is the logic. If you grasp the logic, everything would be simple. And then we said the debentures were issued, this is only on the debentures. Then we have the issue of the rights issue. Like I told the company accounts, rights what? Rights
Rights
issue,
issue.
like I told you, and we also have a bonus issue. So we have a very,
Okay.
very essential matters here if you have looked well. We have the issue of
Okay.
bad debts. You can see bad debts here, right? And
Yes.
we have the issue of prepaid expenses on rent or what, or accrued
You are
expense.
not moving, I think. I'm not seeing.
I'm not.
You are not moving. The case is not moving.
Can't you see it moving now?
No, I'm
Ah,
still on investment property.
okay. Let me go up. Let me go up. Let me go up. You're still on investment property. Let me check this. Let me Yes, I think now it's fine. Yes. So I was thinking of this. You could have had investment property. You could have had this is financial instruments. Of course, we just see a bit of financial instrument. So I don't want to confuse you. You could have
Okay.
taxes as 12, the debentures. You would see about the rights issue, like you see here, and what? In the bonus issue, you would see about the
Yes.
budget. You would see about the rent, right? And we are going to prepare
Okay.
this statement. You could see A, B, C,
Okay.
or D, F, I think that's an issue. So you deal the
Profit and
statement
loss
of
and
profit or loss,
currency.
statement of changes in equity, and the statement of financial
Okay.
position. And
Position.
after that, maybe we would come and deal with another one other statement.
Okay.
I told you that statement of income statement by nature, if you do remember. Income
Yes.
statement is by nature, yes. So you're also
By nature.
yes, we're also going to do this. So
Okay.
I'm really at ease. I'm really at ease. Tomorrow we can just say, okay, no problem. I don't care. Let's just do one thing. We are only going to do one what? One question,
One
and
thing.
the next day we do the other question, right? And then we be
Okay.
done with this, and we remain with consolidation. After consolidation,
Okay.
now we'll be at complete ease, and I think everything will
Okay.
be fine. So that's all for today, I think.